Today, my name is David Brooks, a licensed financial professional. And today I'm going to be talking about the 5 parties to an insurance policy. So basically, there are 5 parties attached to an insurance policy. Number 1 is the insurer, which is the insurance company. So they're the one that places the life insurance on the individual. And the second party is the insured. That's the one that the insurance is on. Number 3 is the owner of the policy. Number 4 is the premium payer. And number 5 is the beneficiary. That's the one that receives the death benefit when the person passes away. So people always wonder, well, why is insurance, sometimes they think insurance costs too much. But you have to remember, when a policy is issued, say you get $1 million policy, and then you make 5 payments, say of $1,000 a month for $1 million policy. Then you paid $5,000 to an insurance company, and then you tragically pass away. Or the insurance company has to pay your beneficiaries $1 million. So who wins in that scenario? Your family will definitely win because they'll receive that $1 million. So that's why, sometimes people, wonder why does it cost so much for life insurance? Because you got to remember the insurance companies is responsible for paying out their death benefit. And then the insured, that's the individual that the insurance is on. They have various policies too. Like they have one that's called the Index Universal Life, and it comes with living benefits and long-term care. And so the insured can take advantage of those living benefits. Where they have critical, chronic, or terminal illness riders attached to these policies and long-term care. Say if you have $1 million policy with a long-term care rider and you needed some long-term care. It kicks in after 90 on the 91st day. There's a 90-day elimination period for long-term care. And so basically you would get 2% of the death benefit per month paid out to you from that policy until you get better. So that way you don't have to worry about going to your savings account to pay for medical expenses. You can use your insurance policy to pay for those medical expenses. And so that's why they call it living benefits, because you can take advantage of the policy while you're still alive. And then the owner of the policy, anybody can be the owner, but it has to be like a relative, a daughter. If a trust can be the owner can be the insured itself, the person that the insurance is on. It could be the husband, it could be the wife, it could be the children, it could be the grandchildren, or it can be a trust. So although various entities can be the owner of the insurance policy, and then the beneficiary can also be the husband, the wife, the children, the grandchildren, or a trust can be the beneficiary, and they're the one that will receive the death benefit tax-free when the person passes away. So if you like to learn more about life insurance and basically see if you can qualify, because one thing about life insurance, you do have to qualify based on your health. So life insurance is always based on your health, and so that's why everybody doesn't qualify. But one good thing about that, these new policies like the IUL, the Index Universal Life, has cash value attached to it, and that it earns interest, and that interest is earned tax-free inside of the life insurance policy. So we want to take advantage of that. Just reach out to me and just text me or message me, IUL, or just book a complimentary appointment on my calendar. And so that's my tip for the day, and you guys have a great day.